Hey everyone, welcome back to the Money Level Show. Today we're going to look at Lyn Alden, who is one of my favorite investors and macro thinkers, and she does a lot of research on historical cycles within money and things like that. And I'm a nerd. I like to go deep into this stuff. I really love to know the history behind money and how it works and things like that. But in this particular podcast, Lyn Alden is talking about currency devaluation and what that looks like for an economy and how we may be heading into that in the 2020s. So let's watch this. Let's listen to what she's saying, and then let's try to understand more of what is happening in the background of our economy.
So Lyn, I want to jump in here because your prediction when David asked about what are the 2020s going to be like, you used this term currency devaluation, and then you made the apt point that everyone always thinks the next crisis is going to be similar to the last crisis that they lived through, or even the one before. And the trouble with something like currency devaluation is we all know, all listeners, like they felt 2008 at some level, right? Most of them were either kids or like a little bit older. But I'm guessing the vast majority, maybe 95% of our listeners today, Lyn, they have no idea what the 1940s felt like, right? And the type of currency devaluation that you're talking about, you liken a bit more to the 1940s rather than kind of the 2010s or maybe even the 1970s. Can you paint a picture for us of what you expect in this term currency devaluation in the 2020s? What you actually expect that means for, I guess, ordinary people living and investing and trying to save money in this world? What were the 1940s like that are going to be similar to the 2020s?
Yeah, sure. So if you look at, over the past century, the United States has had three inflationary decades, or two of them so far, and we're potentially like moving into a third one here. So if you look at the 1940s, they had just come out of the Great Depression, right? So you had this big kind of deflationary impact. But going into that, in the 1930s, there's a big private debt bubble, and that all unraveled. There was farmer debt, there was business debt, there's financial leverage, and a lot of that unraveled and was a big deflationary shock. So what the United States government did was they devalued the dollar relative to gold. So the dollar was backed by gold, and they changed it so it was backed. $1 is worth less gold, and that helped the banking system recapitalize because they hold gold as reserves, and a lot of their liabilities were dollars. And so if you change that ratio for how those work, suddenly they have more dollars worth of reserves because their gold reserves are worth more dollars. And so that was a devaluation, but it wasn't very inflationary because, again, that was mostly inside the banking system. And so all that did was kind of undo a deflationary spiral. It wasn't until the 1940s that you saw actual inflation, and that was because the US government started to run massive deficits, like 15, 20, 25% deficits a year. And because there's so much treasuries issued to fund those deficits, the public couldn't buy them all. And so you had the Federal Reserve basically print money, buy treasuries. And because sovereign debt was so high, so federal government debt was over 100% of GDP, when you started to see inflation, they couldn't raise rates because it would render the U.S. government insolvent, because when you have 100% debt to GDP and you're running 20% deficits, you can't have high interest rates on that. And so they just said, no, we're going to lock yields at 2.5% or less, and we're going to buy any treasury we need to in order to maintain that peg. So you had inflation going to the double digits, even as interest rates stayed at 2.5%. And so anyone holding cash or treasuries, you got all your money back nominally. No one defaulted on you if you were holding that safe paper, but you lost purchasing power compared to commodities.
Hey y'all, so I know these are some complicated terms when you're talking about currency devaluation, inflation, deficits, things like that. And I want to make sure that you understand this. So what Lyn is talking about with a currency devaluation, it means that your money is losing more and more value. And what that means is that you cannot purchase as much as you could in the past with your current dollars. And so that is what currency devaluation is in a nutshell. But how the government does this is that when they go in and they print more and more money, it devalues the currency. And so this is what we're seeing right now, as we've seen the broad money supply go up really high. You can check this out in my video. I'll leave a link in the description where I talk about M0, M1, M2, and M3. But as the government continues to print more money, hand out stimulus checks and things like that, the currency is going to continue to be devalued. Another thing is the deficits. The trade deficits are really high for the U.S. and the U.S. is currently spending over 60 cents a dollar borrowing from the Federal Reserve. So the Federal Reserve are printing money and they're buying U.S. treasuries, which is debt. That means that the U.S. has to pay the Federal Reserve back from those treasuries with interest. And so that is why she's talking about they're not raising interest rates, because if they raise interest rates, the government could not pay the Federal Reserve back. And so the Federal Reserve came in when the pandemic started and they started buying up all the treasuries, as you can see in this chart. And there was a big dip in foreigners buying treasuries because usually China, Japan, other countries buy treasuries from the United States. And so they pretty much finance our debt and we promise to pay them back. And so now the Federal Reserve is the biggest buyer of treasuries in the United States. And this reminds Lyn of the 40s, because this is what happened in the 40s. So what we're seeing now is playing out right before our eyes. And in the 1940s, there was a lot of inflation. There was an inflationary decade where the prices of goods and services went really high because they weren't able to raise interest rates. And with that, Jerome Powell said the Federal Reserve needs inflation to go really high. They are unable to do that themselves directly, but they're saying that they need inflation to go high because the interest rates are so low right now. So they need the prices of goods and services and taxes, even taxes, to go even higher. And so that is what Lyn is talking about in this piece right here. So we're going to go ahead and dive a little bit more into that and just kind of see how this is going to affect our future. How is it going to affect our money and what we can do about it?
So let's talk about that for a minute, because like I said, none of our listeners have lived through that, right? So T-bills are a safe bet right now. That's kind of common knowledge. But what you're saying in the 1940s is they were not a safe bet. You could end the 1940s by storing all of your value in US T-bills, essentially, and have a lot less value than when you started the decade. What was the move to make in the 1930s and in the 1940s as kind of an investor that's just trying to store wealth and store value through those decades? Who were the winners and the losers?
So most of the moves to make back then would have been basically to buy equities or to buy commodities. And that's because, of course, throughout the 1930s, equities were very cheap because it was, growth was slow, everyone was pessimistic. And then when you're fighting a war, not many people are buying equities, and so they were very cheap there. And so it basically the right move was to buy equities, buy commodities, because those were all in demand. And as the war kind of went on, you had, of course, you had commodities spike in price, and then as the war ended, the stocks did very well. And so the worst move to make was basically to hold money in the bank or to hold treasuries, because even though you did get all your money back, there was no nominal risk. It's not like the U.S. Treasury defaulted. It's just that you got all your dollars back, but at the end of the decade, they lost roughly a third of their purchasing power. So you could buy about 1/3 less of a home. You could buy a third of the amount of copper. You could buy there's different ways to measure it. Some things are more or less, but overall it was about a third of your purchasing power, which, over a decade is terrible. I mean, over a decade, you expect to grow your purchasing power, but with those kind of paper investments, you instead lost about a third of it.
And you think, Lyn, something like that could happen in the 2020s. So I have $1,000 and I want to store my wealth for the decade. At the end of my decade, my nominal value may be higher, but my actual purchasing power might be 70%, might be $700 rather than 1,000 at the end of the 2020s. You think something similar could happen?
I think potentially. I mean, even if you look at over the past decade, if you held, for example, T-bills, so the short end of the Treasury curve, you lost a few percent of your purchasing power compared to CPI or compared to assets. Like you can buy a little bit less house, you can buy less, of Apple, Apple's market cap, whatever the case may be. You basically can buy less stuff than you used to. The one thing you might be able to buy more of is certain commodities like oil, for example, because you've been in a commodity bear market. But in terms of official CPI, which of course has its own flaws, you can buy less stuff with your $1,000 held in T-bills because it just failed to keep up with inflation. But of course, it's a very small loss. It wasn't a very large loss. Now in the 2020s, I do think it could be more significant. I think at the very least, you're going to get another one of those decades of just gradually losing purchasing power. Then it's possible like that you can get more like the 1940s or the 70s, in terms of losing 10%, 25%, maybe more.
All right, so Lyn is dropping a lot of knowledge right here. I'm telling you guys, she is one of my favorite investors and macro thinkers and researchers. And so what she's saying is that in the 1940s, if you hold treasuries, which a lot of times the American citizen would buy treasuries and the US government would pay them back in interest, and that person would technically get more money than what they invested. And so when I say more money, that means that nominal value means that, okay, if you invest $1,000 in the treasury, they pay you 6% of $1,000, and you get $1,060, so that is what I mean by nominally. But however, with inflation, you cannot purchase as much as you could with that $1,060 as compared to how much the things cost. And so that is what Lyn is saying, is that people held treasuries back then and they ended up losing a third of their purchasing power. So if you held treasuries and they paid you back 6%, and then at the end of that 10-year period or whatnot, you held the treasury for a decade, the government paid you back, you cannot purchase as much as you could as before. And so that is why she's saying that in the 1940s, people lost out by investing in treasuries. However, she says people bought equities because in the 1930s, they were cheap. And then also people bought commodities because commodities were cheap, because commodities go up in value during inflationary decades. And so in the 70s, you can see that the oil boomed and gold boomed as well. And so those prices of those commodities go really high. And so that is what Lyn is saying, is that you have to invest in things that are going to go up in value as inflation starts to creep in and inflation starts to kill your wealth. And so that is the key thing that I took away from this interview, is that, okay, what can I do looking forward? How can I invest? How can I set my family up for the future? And that is why I buy things like gold, silver, Bitcoin. I buy things like, oil stocks, uranium stocks, things like that, because those are commodity stocks. And it's like, okay, well, if we're going to have inflation in this decade, then we're going to see commodities go skyrocket. So that is kind of my long-term outlook on it. So Lyn painted that picture really well for what to expect going forward. A lot of times people see, okay, yeah, the market already crashed in March of 2020 or April of 2020. But we have not seen the full consequences of the amount of debt that has been created, the amount of money that has been printed. We're still constantly seeing about 1 million people filing for first-time unemployment benefits a week. So the economy is not in good shape, and we're seeing that the assets continuously rise in price. We're seeing stock markets hitting all-time highs. We're seeing Bitcoin hitting all-time highs. We're seeing real estate hitting all-time highs. And so things like that are going up in value and going up in price. However, once inflation kicks in, we're going to see gas prices go high. We're going to see oil prices go high, uranium, gold, silver, all those different commodities, copper, nickel, lithium, all those things are going to continuously skyrocket. And so that is why we want to get prepared and be able to invest with a long-term outlook, looking at the big picture of what is going on around us, not the micro of what's happening in the stock market now, where we see like Tesla being overvalued. We're seeing a lot of these companies being overvalued and going up in price. And yes, you can make money right now. However, there's going to be a time in the near future, that we need to look at these other areas that are going to go up in price before we miss that boat. And so we've got to look at where the puck is going, not where the puck is at. And that's what Wayne Gretzky said. And I love that quote. So I want to thank you all for checking this out. Be sure to check out the link in the description. I put the link for Bankless, their interview with Lyn Alden. I thought it was really great. I put that link in the description. So be sure to check that out. Shout out to them. And y'all, thank you for joining the Money Level Show today.